Are there any tax benefits associated with maybe carrying paper? And if so, what are they?
I mean, the primary benefit from a tax perspective is being able to spread out that capital gain over a number of years and not having to pay all that tax at once, especially as it bump you into a higher tax bracket. That's the principal tax advantage that you see out there.
Is the owner paying taxes just on principal collected, or are they paying taxes on the interest collected as well too?
Yeah, so as the seller and you're taking back those monthly note payments, you're getting a portion of principal and then a portion of it that's interest income. So the interest income will be taxable to you just like any other interest income you might earn from your bank or your Vanguard account, whatever it happens to be. So that's regular taxable income taxed at ordinary income tax rates. And then the principal portion you receive is that proportionate share of your gain is how much of your gain you're going to get taxed on each year. So it's not a completely tax-free transaction.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Residual Real Estate Agent Show. Today, we have a repeat guest. His name is Andrew Kiefer. Andrew is actually my accountant, and this is the person that I go to whenever I have any real estate tax-related questions. To say that I really appreciate Andrew is an understatement. Welcome back to the show, Andrew. How are you?
Good. Thanks for having me back again today.
Good. So the reason I wanted to have this episode is I get a lot of people that want to potentially sell an investment property, but their concern sometimes is that if they sell an investment property, that there's potentially going to be tax consequences. So some of the homeowners are exploring doing owner financing. They ask me questions and sometimes I really don't know how to answer it. So today's topic was going to be, what are the tax benefits for a seller for potentially considering carrying back paper or financing the home for the buyer? And that's what I really wanted to cover. But before we get into that, Andrew, how did you get into accounting? And if you wouldn't mind telling the viewers a little bit about yourself as well, too.
Yeah, so I got into accounting in college. I've always been good at math. Like money, so it was a good natural combination. I've been practicing public accounting for 24 years. I work with CBIZ Merhoff McCann. We're a national accounting firm. My office is in Oxnard, California. We service primarily small and mid-sized businesses here in Ventura County out of our office, but provide a variety of services, all sorts of business throughout the country.
Thank you. Thank you. Okay, good. So let's get right into the topic. We talked about this a little bit. Like, are there any tax benefits for somebody maybe looking to sell a property, and maybe if it's an investment property, are there any tax benefits associated with maybe carrying paper? And if so, what are they?
Yes, so there could potentially be some tax benefits there. And like you said, this needs to be on an investment property. There's not really a lot of tax advantages to do owner financing if this is your primary residence. And so what we're talking about with doing owner financing is typically when you have a sale of a property, the buyer goes to the bank, gets a loan. That bank then pays you, the seller, the money for the property. In an owner financing situation, you eliminate the bank from this equation, and you, the seller of the property, essentially become the bank, and you are the one that the buyer is making the monthly payments to. And so that's, in essence, at a high level, how this would work. So a potential tax advantage of doing a sale this way for an investment property is what's called an installment sale. So typically when you sell a rental property or a second home and you sell the property, the bank gives you the money or you receive 100% of the proceeds up front, you have to pay tax on all of that money in the year that you receive it, in the year of the sale. However, if you do an owner financing transaction, the buyer is paying you the money over time. Typically there's a down payment involved and then monthly payments structured over a set amount of time. In that instance, you have an installment sale, and basically you get to divide up your gain, your taxable gain on the sale of the house, and spread that out to only pay tax as you collect those payments. So for instance, let's say we sell a house for $500,000, and I'm going to pay tax on $500,000. If I were to sell this through a bank transaction, I have to pay tax on that $500,000 immediately, all at once that year. However, if I did an owner financing transaction, and let's say I take a $100,000 down payment and I have monthly payments of $1,000, Year one, I'm going to pay tax on collecting, let's just make it real simple and say $112,000 because that's what I collected that year. The second year, I would collect another $1,000 of payments. I'd collect another $12,000, pay my proportionate share of the gain on tax in year two. So I'm able to spread out my tax bill over the years that I'm collecting payments from the buyer.
So, and I guess this is something for people to understand as well, too. Like some people may look at it, well, look, I'm going to pay the taxes regardless. Why not pay them up front? Is there a benefit for, like, let's say that the gain is 500,000 towards spreading out that gain? And I think that's kind of what we're maybe alluding to. Or is it the same thing? Like if I'm going to pay the same tax amount, but just in smaller installments, am I going to end up paying a very similar amount? And if so, like what would the actual benefit be?
Yeah, so right now, capital gains taxes for federal tax purposes, you either pay at a 0%, a 15%, or a 20% tax bracket based on your total income. For the state of California and many other states, there is no special capital gains taxes. But if you are in a situation where your other income from your job, your spouse's job, perhaps you sold some other stock, something like that, was going to push you from a 15% taxable gain up to a 20% taxable gain, you could look at deferring and doing an installment sale and keeping your income below a certain level so that every year you're in that 15% tax bracket. Or even potentially, if you know this is the last year that you're working and your income is going to substantially drop in future years, this is a way too to get into lower tax brackets in future years where you could have some really low taxes payable on this installment income that you're receiving.
Okay. So basically, like sometimes, like let's say they have $1 million gain, that would push them into a higher tax bracket. So
Right.
instead of paying 30, you said 0, 15, and 20 or 0, 15, and 30?
0, 15, and 20 for federal
So
purposes.
20. Okay.
Yeah.
So basically, there's a chance that you may be pushed from a 15 to a 20% or from a 0 to a 15.
Right.
And you don't have to know this, but would you happen to know roughly the numbers that would keep you at a 0% tax? Because I had never heard of a 0% capital gains tax bracket.
Yeah, it's pretty low. For married individuals, the 0% is around, I want to say $60,000. It's pretty rare to see that happen. So, so most people are in that 15%. And then once your income approaches the $450,000 to $500,000 level as a married couple, that's when you get up into the 20% bracket for the capital gains. So if you know your income is on that borderline, it's something to consider because you could be saving 5% of taxes.
Yeah, which on $1 million could be like $50,000 or a different amount, and then you're still going to get the money regardless if you do an owner or potentially depending on that. Now, can we talk about like some different maybe examples that you've seen? I'll go over one where we had a homeowner who sold us a property at $500,000. They said pay us 50% of it this year, and then the other 50% of it next year. We closed on his property like in October, November, and then 2 months later he received the other benefit, but that was like one of the times where I was like, man, that was like extremely creative because he might have been at 500,000, depending on what he purchased it at. He might have been over that 450 to 500 range. So he said, if I just structure it this way, I can save an extra 20, 30, $40,000 in taxes by just waiting a couple months. That was one of the ones that I saw. Do you mind kind of sharing with us maybe the most common ways that owners do these types of installments that you've kind of seen from a tax perspective?
Yeah, your example there is pretty unusual, but I'm sure that the seller did that for tax planning reasons. They collected half of that money in, say, 2021. They paid half of the gain of tax that year. They collected the second half in 2022, and they're going to pay the rest of the gain in this year. So that's not a common transaction. Usually what I see in an owner finance situation is that the seller will take back a note for maybe a 5 to 7 year term with the anticipation that they are collecting a monthly installment payment of both principal and interest for 5 to 7 years. And it's not like the full loan is fully amortized over 5 to 7 years. That might have a 20 to 30 year amortization. So the payments are set up as if you're paying over 20 or 30 years, but the loan is due at the end of 5 or 7. So there's generally a balloon payment due at the end of 5 or 7 years. And the theory behind that is at that point in time, the house hopefully has appreciated. The buyer can go out and get traditional financing, refinance the property, and then you get the rest of your money at that point in time. So that's scenario number one that I typically see as a 5 to 7 year scenario. Or the other extreme that I see is a full 30-year, fully amortized loan where the seller will hold on to that note and collect payments for the full 30-year term that you would get with traditional financing with a bank. They both operate mechanically the same way. Obviously, with a shorter term, you probably have to look at a balloon payment and refinancing. If you're looking at a 30-year term, you're going to get paid out in full over that entire 30-year period.
And then as it relates to paying taxes itself, is the owner paying taxes just on principal collected, or are they paying taxes on the interest collected as well too? And do those taxes work differently? And if so, how?
Yeah, so as the seller and you're taking back those monthly note payments, you're getting a portion of principal and then a portion of it that's interest income. So the interest income will be taxable to you just like any other interest income you might earn from your bank or your Vanguard account, whatever it happens to be. So that's regular taxable income tax at ordinary income tax rates. And then the principal portion you receive is that proportionate share of your gain is how much of your gain you're going to get taxed on each year. So it's not a completely tax-free transaction as you're paying income taxes on your interest income. However, generally in these scenarios, the interest that you're charging, I mean, you're taking on risk as the seller. So the interest that I would want to charge is probably going to be higher than putting the money in the bank in a CD because I'm taking on risk. I want to be compensated for that risk that I'm taking on. So if a bank right now is paying, I mean, what, 1 or 2%, maybe 3 if you're lucky, you could probably put owner financing out there at 6, 7, 8, maybe even 9%, depending on the buyer. And you could be earning a higher rate of return than you would if you invested this.
Yeah, absolutely. Not only that, but a lot of times, your basically collateral is the asset that you already owned. So if you know that that asset performs a certain amount of cash flow or a certain amount of rents, then your owner financing is secured a lot of times by that property already. Now, I've kind of seen it where sometimes people get a little bit creative as well too. Is there any benefit for somebody? Because I have a owner financing deal on a $4.4 million building that I own, and the owner actually carried back $4.3 million on it. So I only had to come in with $150,000 down. And the way we structured it is we structured it where I only put $150,000 down. For the first 5 years, we did interest only. And the logic for me and the seller was that during those first 5 years, I was going to be reinvesting a lot of the money that I would normally be investing into the principal back into the building to renovate it, therefore increase the rents, bring the income on the building up. And then obviously once the 5 years up, a lot of that would go for the principal, or the rents would be higher. And now the rents are higher. So now paying the principal is a lot less because the rents are a lot higher. So it gave me time to stabilize the building. Is there any tax benefit towards doing something where it's interest only payments versus principal and interest? Or is there anything that you've kind of seen in that regards? Because what's cool about owner financing is that you can structure it however it is that you want. Meaning, like, if you want to structure it in a way where you receive X amount of payments or Y amount of payments, you can really get very creative with it, basically, is what I'm trying to say.
Right. I mean, that's one of the advantages of doing owner financing is it really allows the buyer and seller to agree upon their own terms. And maybe a buyer can't obtain the normal financing that they can obtain from a bank, or they don't have a big enough down payment to qualify for certain programs that a bank might have. So this allows the seller and a buyer to work together to figure out a mutually beneficial agreement. And in a situation where there's interest-only payments, especially in an apartment building, which is typically a piece of property that appreciates in value, the advantages for the seller are by collecting interest only for the first 5 years, he's not paying any tax on the gain on that sale of property until year 6, because all he has collected is the interest over the first 5 years. And so he has deferred the gain or the taxes on the gain for basically 5 years. And then that allows you as the buyer of the property, like you said, to renovate the property, probably increase the value of the property as well. That if you wanted to go out and refinance that property at a lower interest rate and pay off that loan at the end of 5 years, you're going to have an appreciated piece of property that you're probably not going to have to put any more money into in form of a down payment to satisfy a bank. And that allows you to finance it perhaps more easily.
Now, how does somebody protect themselves? Like, let's say I'm considering doing an owner financing type of deal. I'm considering offering terms to somebody or an installment sale. As a seller, like, what would you be looking for in order to protect myself? Like, in terms of like, does it make a difference in terms of what position I'm in, like first or second position? Does it make a difference as to how we structure the interest? Like, what can I do as a homeowner if I'm actually considering this?
Yeah, so the first thing I would do is get together with a real estate attorney to make sure you're going to have legal documents drafted that protect you as the seller. As the seller, you're taking on a certain amount of risk. And so you want to make sure that you have all the proper documentation in place. So you're going to have a sales contract that's in place that has the agreement between you and the buyer. You're also going to have a promissory note that states the sales price, the interest rate, the monthly payments, down payments, when the loan is due, all of that good stuff. So you want those documented. And then you're also going to want to file all of these documents with the county that the property is located in so that you have a recorded lien on the property. Typically, if you're working between a buyer and a seller, you're going to be in a first position on that house. And that protects you as the seller should the buyer default and you have to go into foreclosure. You have all of the legal documents in place to protect yourself so that if you do have to foreclose on that property, you can do it with, like I said, spending the time up front, hoping this never happens, but you will protect yourself should it happen and you have to go through that foreclosure process.
And then what about like, do you ever see owner financing terms where they're carrying a second loan? And how are those typically structured if you ever see those?
I don't typically see those because banks don't like that. Banks will always be in the first position. And so, should there happen to be a foreclosure or anything like that, the bank's going to get all the proceeds and take all that process on. You get what's left over as a second position. So, I can't recall ever seeing coming in as a second position on a loan. I know it's out there and it's possible, but it's just not something I see in practice very often.
Basically. So what Andrew's trying to say is that there's more risk associated if you're in second position than you're in first. Meaning, whenever you're in second position, if the buyer gets behind on their payments, in order to foreclose, you have to pay off the first loan, and obviously that's the way that you can foreclose. And the first loan could be relatively high. As
Right.
comparison, if you're in first position and the buyer stops making their payments, there's nobody else that you have to pay in order to be able to do that. Anything else like in terms of tax advantages or tax benefits for owner financing for the homeowner?
I mean, the primary benefit from a tax perspective is being able to spread out that capital gain over a number of years and not having to pay all that tax at once, especially as it bump you into a higher tax bracket. That's the principal tax advantage that you see out there.
Now, the other reason that I usually see these installment sales happen is like, let's say that somebody doesn't need the capital. Like, let's say that I don't have anywhere else where I would put it, and I don't want to pay a large amount of money in taxes. It gives me an opportunity to, one, spread out the taxes. Two, it gives me an opportunity to collect cash flow. Like, some landlords are so used to collecting cash flow that they love receiving a monthly check every single month that they're more willing to do something like that. The third reason is that, as opposed to just collecting rent, now you don't have to deal with any of the issues that come up. The new buyers dealing with any of the issues. You're literally just collecting payments. Now, the one thing that I would say that you can protect yourself is, if you are doing it, you may want to consider being in first position. The other thing that you would want to consider is, the higher the down payment, the more collateral that the buyer has and the more skin in the game that they have. So sometimes when you do like owner financing with less down payment, the buyer can walk away from the property because it's less money down. So just be really careful as it relates to that, because the more skin in the game that the buyer has, the least likely he is to walk away from a property, and the more security that the owner has. Not only that, if they stop making a payment, now let's say they bought it at $1 million, they put $300,000 down, the loan is only $700,000, and you have an asset that could potentially be worth $1 million. So there's some equity in there as losses or damages to the home seller as well too.
Right. I mean, yeah. I mean, you figure if somebody's going to put 30%, $300,000 down on a piece of property, they're less likely to walk away, because if you as the seller foreclose on that piece of property, you don't have to give them back their principal payments that they made to you over that whole time, including the down payment. And so, like you said, if they got more skin in the game, they're more likely to find a way to figure it out so that you get paid. Whereas if you go in and only put 5% or only collect 5% down, there's not a whole lot of risk that the buyer has. And they might, if property values decline, if we're in a slump or something like that, somebody loses a job, they might walk away because they might only be in the property for 30, 40, $50,000. And then it comes back to you that you have to go through the foreclosure process, take repossession of the home. But that's the good thing, at least, is if you have everything leaned and perfected correctly, you at least have the collateral of the property always backing you up.
Now, here's the last question that I had for you, Andrew. Is there like some sort of software or is there like some sort of analysis that an accountant can do and kind of run different scenario as to different terms for an owner financing deal? Like, let's say somebody wants to sell their property. They don't want to pay the huge tax amount up front. They want to spread it out, but they don't know how to structure the deal. Is there something from a tax perspective that somebody like you, a colleague, or what would be the best way to kind of run different scenarios? Because I imagine that a owner financing deal can be structured where it benefits both parties. It benefits the buyer and it also can benefit the seller as well too, just depending on how it's structured or what type of due diligence should somebody do if they're considering financing a property for the buyer.
Yes, so we can do tax projections and tax planning to advise the seller onto what would be the potential tax ramifications of different terms, different interest rates, different loan amounts, different down payment amounts. We'll calculate their gain. Their gain is typically going to be a fixed amount, and then it's just a matter of how many years you have to pay that taxable gain over. The one unknown that comes into play in these types of scenarios is if you are doing an installment sale that goes out into the future, there's a good chance tax rates are going to change in the future. We don't know when that's going to happen or what they're going to be. So a deal that looks good now, 5 years from now, might not look good once you have new tax laws in place. Vice versa, something that looked maybe not so good right now, 5 years from now may have been like, oh crud, the tax laws have changed and really benefited us, we should have. So that's always kind of one caveat. One thing I want to throw out there is none of us have crystal balls to know exactly what's going to go on in the future. So there's always that level of risk. But we can definitely provide different scenarios of the tax implications of the different types of sales structures that you can do. And one thing you said too about getting back into looking at doing this is another thing to do is do credit checks on the buyers to assess your risk and make sure that this is a good candidate to enter into, that you're taking on an appropriate level of risk for your situation and that you're willing to accept this risk. And one way to do that is always looking at the buyer's credit history to kind of evaluate the odds that they're going to repay you.
Not only that, but also be able to look at like their like almost like I think what Andrew's trying to say is that if you're going to take on this level of risk, almost underwrite it. Like if you were a bank, like if you were doing a traditional loan, like make sure that the buyer doesn't have like a bankruptcy, doesn't have like any like 10 missed payments on their home mortgage currently. And that's the reason why they can't get. So basically what Andrew's saying is that you can do due diligence as it relates to the buyer itself, like meaning what's their credit score, how much income do they make, what does their credit look like, how much debt do they currently have. You can protect yourself also by asking for a higher down payment because that's collateral. And then also you can protect yourself just by doing tax projections as well too, which I think that's the part that I think is good for different sellers. If you're considering doing an owner financing deal, you might want to run different scenarios. That way, if you do it, you know how to structure it correctly to benefit your current situation, basically.
Right. Yeah. Just knowing all these variables that come into play. And I've done this analysis before for clients where they're looking at doing some sort of installment sale and taking back the note. And once they see the level of tax they have to pay at year one sale versus spreading it out, sometimes the difference isn't that big. And they're like, forget it. I don't want to take on that risk myself. I'm going to pay all the tax year one. And then it's all overdone with. You don't have to worry about it going forward. Other times it makes sense to spread it out and pay tax over time. Another thing you brought up too is a lot of these that we see are rental properties that are existing with a landlord and will probably continue to be a rental property. So that landlord likes to see that regular monthly income. They're usually used to doing background checks and evaluating people's credit. And so they're kind of comfortable in these situations already. And so they're typically the type of person who might be more willing to do an owner financing transaction than just a married couple that's a first house that they're selling for the first time. They might not know that much about real estate and be less likely to do it. But if you get somebody who's in the real estate profession, who's been dealing with landlords and buying and selling property, they're probably a little more willing to do that type of transaction.
And sometimes it's not even the tax benefits. Like we've been focused a lot on the tax benefits, but what you're saying is that sometimes it could be like, hey, I just want the monthly installments. I just like
Right.
the fact I don't want to have $1 million just kind of sitting in my account. I'd rather get $5,000 every single month. That's going to
Yep.
keep me feeling good. Now, you said that there's been scenarios where it does work out, meaning like after they see the scenarios, they're like, yes, I could save this amount of money, or for whatever reason, it does work out. And then there's been times where they kind of run the analysis and they're like, well, look, I'm only going to save $20,000 in taxes and I have to wait 7 years to get my money back. Is there like a differentiating factor that you've kind of seen in these situations? Like based on, are these usually like higher income earners or anything that like a pattern that usually determines for most people whether it's worth it or not? Or is it just more on an individual type of basis for each individual?
It's usually on a case by case basis, but it usually is the differentiator comes to how much tax do I owe now versus how much tax do I pay over time. Am I saving enough to make it worth it to me to take this risk on?
I love it. Good, man. If somebody wanted to get a hold of you, if they like the information, maybe they wanted to hire you as their accountant, how can they get a hold of you?
Yeah, thanks. So, yeah, my phone number for our office is 805-988-3222. And my email address is akiefer@cbiz.com. That's AKIEFER@cbiz.com.
Fantastic. And I just want to thank our viewers for taking the time to watch this episode. Once again, Jose Luis Morales, the Residual Real Estate Agent Show. We had Andrew Kiefer. Today, he talked to us about the tax benefits of owner financing a property to a buyer. So basically, if you're a seller and considering doing owner financing, what are some of the different tax incentives, what to look out for, what to watch out for, what to do, what not to do. I want to say thank you to Andrew and thank you for all our viewers. If you've enjoyed this episode, make sure to hit that subscribe button. And then if you've enjoyed the episode and think it would be helpful to a friend, neighbor, family member, make sure to hit that share button. Once again, thank you so much, Andrew. And
Thank
to all
you.
of our viewers, we appreciate you guys as well, too.